Research at Citi, Markets Edition.
Welcome to Research at Citi, Markets Edition, where we break down global macro in 10 minutes or less. I'm your host, Dirk Willer, Citi's Global Head of Macro, and with me today is Adam Pickett, our London Macro Head. Welcome to the show, Adam.
Great to be here, Dirk.
We are recording this podcast at 8:30 a.m. on Monday, April 20th, 2026. Geopolitics have continued to generate volatility, but different markets have reacted to Iran headlines very differently. We will investigate why and what it means going forward. So let's dive right in. For the market, it really only matters if and when the Strait of Hormuz can be opened. On that front, at the time of recording, the story is still unclear. After an initial agreement by the Iranians to open it was closed again on Saturday, with Iran blaming the continuing US blockade of Iranian-linked tankers. Citi's baseline is still that a negotiated solution can be found over the next weeks, but uncertainty prevails. What is interesting is that different asset classes are pricing risks differently. Brent has pulled back from around 110 to the mid-90s. Not just futures, also physical has actually pulled back somewhat from the highs seen in early April, but it remains well above the low 70s level from end of February. The argument is, of course, that even a positive outcome, the restart will take some time and inventories need to rebuild and may even increase. This takes time, and if anything, our commodity team sees there's still upside risks for the oil market. In equities, the story is somewhat different, though. Many markets are well above the late February levels. That was the case even before Friday's news about the reopening of the Strait. This is especially the case for the US, as well as some commodity-heavy markets in emerging markets. How come? For the US, the story is a combination of positioning and good earnings. Since the start of the conflict, one-year forward earnings estimates have risen for US equities, partly driven by semiconductors. At the same time, investors had sold US equities, and tech in particular, to broaden out and invest into the rest of the world. Positioning was therefore extremely light in the US. Both strong earnings, i.e. fundamentals, and strong technicals, i.e. positioning, explain the good performance. For the rest of the world, earnings estimates also often rose, but positioning was less favorable. What now? Whenever a crisis strikes, a lot of the gains accrue not so much during the crisis because it's very hard to trade these markets from the short side, but they accrue when markets calm down, when volatility is falling. In particular, when VIX is falling below 16, we expect more investors to come in, which would support the market. In FX, the story is more mixed. Many FX have strengthened meaningfully against the dollar since the end of February, but many others did not. The direction and size of the terms of trade shock explains dispersion in FX relatively well. Both emerging markets and developed markets with the commodity angle did well, with Colombia and Brazil being the poster children, but Australia and Norway also doing well. What will happen next? Terms of trade usually remain in the driver's seat while the commodity crisis continues. But when commodities peak, the commodity currencies start to underperform and carry comes back as a factor for FX. We have an indicator based on implied volatilities that triggered a warning for carry already in late January, but is now back in long EM carry mode. Countries like Sweden should also be supported by an unwind of the terms of trade shock. Interest rates came back the least, as they're most closely tracking oil, and they find it hardest to decouple. Mostly the market has priced caution by central banks. Markets where a lot of cuts had been priced in late February sold off the most, while markets that had hikes priced already did not sell off all that much. Going forward, we can distinguish between countries where Citi economists changed their view on the likely rates path and markets where they did not. Markets with unchanged views but that have sold off meaningfully include Brazil or the Czech Republic. Importantly, our US economists have pushed out the cuts but not fully withdrawn them. Without Fed hikes, the US rates environment should be relatively stable, allowing some positions outside of the US to perform. Adam, you did an interesting study on how the betas of the various assets have changed with respect to oil, both upside and downside. What's the punchline?
The punchline, Dirk, is that the sensitivity of a lot of macro markets to equally sized moves in oil has convincingly shifted towards a bigger beta to the downside in oil, which is to say too much deleveraging has gone through, optimism reigns, but ultimately, while it was quite mixed up until the end of March, it's now more convincingly that oil downside moves get you bigger market reactions. In terms of what that means for chasing a more optimistic stance, we think rates, then FX, then equities makes the most sense because the asymmetries in rates to the oil moves is quite large compared to the other asset classes, but also just the retrace levels have not been as aggressive, whereas many equity indices are back back at or near the highs.
Great. And an interesting topic that came up that's linked to the Iran conflict is the petrodollar issue. Is an interesting story brewing, Adam?
I think it could be, and I think it could be a longer term one to watch. We get questions such as, will there be limited petrodollar recycling now that GCC nations have a big either rebuilding bill or defense bill? So those limitations to petrodollar recycling could be a concern for both treasuries and the dollar. We'd make two broad points. One is petrodollar recycling has been limited for the last 10 years anyway, as a lot of these Gulf nations have shifted sort of economic targets towards broadening away from oil, and that costs money, most notably Saudi's Vision 2030 efforts. But secondly, when you're looking at current account surpluses that get recycled into dollar assets, Asia is by far and away taken over the GCC in that dynamic. As recently as 2013 or so, it was neck and neck in terms of cumulative Gulf and broad Asia current account surpluses. Now the ratio, when we look at the IMF data, is close to 10 to 1, at about 1.3 trillion to 130 billion. So if you're looking for current account recycling hints, it's all about Asia. However, the longer term concern is if oil ends up lingering in the 80s rather than doing a full retrace, that could somewhat cap Asian current account surpluses, and it could be something to watch out for as the year progresses when we look at the tick data, when we look at Asian bond ETF flows as a barometer for dollar asset demand, and by extension, either US term premium concerns or concerns for the dollar. It fits into some of the dollar diversification risks that we looked at last year, adds a different flavor to it, and is something that we think should be considered going forwards. One last point on the topic of oil, we also investigated the oil intensity of global GDP, which has been falling for the last 40 years quite consistently. This also passes through into the reduced beta of oil price swings to global oil expenditures. To some degree, this keeps us bullish on equities in the medium term because, in a way, it raises the bar for incremental oil spikes to cause a global recession.
Yeah, I'm sure that will be an interesting theme that we come back to as the year progresses. Just before wrapping it up, I just want to share one quick observation from the IMF spring meetings in DC, just because this quickly changing headlines in Iran, very important to know how investors are positioned. And I would say my main takeaway on the sentiment/positioning side is that there was some bearishness with respect to US equities, where stagflation fears were still fairly widespread, and investors were somewhat taken aback by the fact that US equities are at the highest when oil risks still remain quite severe, at the very least, a very fat tail, even for the bulls. So that still should provide some sentiment support for the market going forward. However, when it came to emerging markets, investors were really broadly quite positive. And that was the case because they were broadly in the dollar camp and the long commodity camp. And that's, of course, an environment that's really quite favorable for emerging market assets across all asset classes, really. And in particular on the dollar, I think there was a fair amount of consensus that the dollar rally we've seen during risk aversion was really fairly small given the size of the shock, which indicates that maybe the underlying cross currents are for dollar weakness. And at the same time, of course, the geopolitics was seen as potentially and slowly undermining the dollar. So big consensus on those fronts, but still hesitancy on some of the equity markets. So in summary, the geopolitical volatility is likely not quite over yet, but with earnings estimates increasing, and as volatility falls, more risk will be deployed, which should be positive for equities. In FX, the carry trade will make a comeback as the positive terms of trade shock will fade, and in rates, several central banks are unlikely to move against market expectations for hike, which also generates opportunities. Thank you for joining us today. This episode was recorded on April 20th, 2026, and I'm your host, Dirk Willer. For more details, Citi clients can check out our report on the Citi Philosophy portal. Next week's Research at Citi Markets Edition will be hosted by Beate Menthe, Citi's Global Head of Equity Strategy. And do watch out for Research at Citi podcasts, which you can view on the same channel. The macro strategy team will be back in 2 weeks' time. Stay sharp.
This podcast contains thematic content and is not intended to be investment research, nor does it constitute financial, economic, legal, tax, or accounting advice. This podcast is provided for information purposes only and does not constitute an offer or solicitation to purchase or sell any financial instruments. The contents of this podcast are not based on your individual circumstances and should not be relied upon as an assessment of suitability for you of a particular product, security, or transaction. The information in this podcast is based on generally available information, and although obtained from sources believed by Citi to be reliable, its accuracy and completeness are not guaranteed. Past performance is not a guarantee or indication of future results. This podcast may not be copied or distributed, in whole or in part, without the express written consent of Citi. Copyright 2026 Citigroup Global Markets, Inc. Member SIPC. All rights reserved. Citi and Citi and Arc Design are trademarks and service marks of Citigroup, Inc. or its affiliates and are used and registered throughout the world.